Are you also excited about the idea of deregulation, acquisitions happening? Today we're talking about Goldman and Northern Trust. Last week it was Huntington.
Let's talk about the financial sector for 1 second. So in the JOT ETF, we have a 30% weighting to financials. And it's really rooted in the belief that fundamentally you've had the combination of a revival in earnings growth, M&A, trading activity, there's strong engagement in trading activity, and then you have the regulatory relief. You add upon that the premise that now you have this technical momentum. So our top performing names, Interactive Brokers, best financial stock we own in the ETF. Charles Schwab, another name. New Holdings, digital banking company down in South America. JP Morgan, obviously performing remarkably well. Northern Trust, Bank of New York. So the financial sector is giving you the growth opportunity. And to Kate's point, when you're thinking about positioning, yeah, positioning could be a little bit extreme. There could be a need to work off some of that positioning. But now Stephanie's going to like this. When you look at valuation, look at the 11 S&P sectors. Where do financials score, even with the rally that they've had? They are the third lowest valuation out of 11 S&P sectors at a current PE of somewhere around 18.5. That's still cheap enough to get me excited and keep me anchored in the sector.
Yeah, by the way, just to your point, Bank of America out with their client flows. Big financial inflows amid bank earnings. So a lot of other investors going into the banks. Speaking of, Stephanie Link, you have a move in the financial space.
Yeah, what we were just talking about. Wells Fargo, they had reported a good number. They beat earnings. They had good fee growth. Provisions were under control. Credit costs were low. Efficiencies were in line and strong and good. They're buying back. They have a buyback program of $40 billion. That's 15% of the market cap. And the stock fell 5% in the day. So I actually added to it. It's now my largest financial services holding. It trades at 14 times earnings. 1.6 times book is not exactly cheap for them. However, with the asset cap lift, I think your ROTCE goes from 15% to 17%, and that's a very good thing for multiple expansion over time. So I used earnings season, silly season, to buy best in breed.
All right, you also own PNC, made some news today announcing a strategic partnership with Coinbase. Just while we're on it,
I don't own PNC.
Oh, I'm sorry.
I own Truist, actually.
Joe T, you own PNC. I apologize. Looked down at my notes, looked at the wrong name. Joe T, coming to you. PNC teaming up with Coinbase to give clients some crypto access.
PNC, USB, we call these names super regionals. Yeah. And candidly, I have a degree of disappointment. I've expressed this over the last several weeks in the way that regionals are trading. It's really idiosyncratic. You have certain instances like a Huntington Bank or a Regions Financial, where Citizens is another example where it's trading well. And then you have other instances where regionals are not working particularly well. Not particularly excited about what I've seen over the last year from PNC. I think it's up somewhere around 11%. You could lump USB in there as well. I think the money center banks is really where you want to find the opportunity right now. Wells Fargo, on a valuation perspective, obviously attractive, but it's also had relative underperformance, and you will get that mean reversion at some point. So I think you could trade higher up. You don't have to go to the regionals, the super to regionals just yet. Stay with the money centers.
All right, speaking of Josh, you own JP Morgan, just your broad take on the financials right now. We're starting to see that deregulation story kind of play out. Again, Goldman looking to acquire potentially Northern Trust, Huntington Bank last week. I'm sure there's some other acquisition targets out there as well.
So the deregulation story is like the climate. Like it exists. And it's a different climate than what we experienced over the previous 4 years. And, you know, it probably in the background has helped people feel a little bit better about, you know, buying some of these wealth managers, asset managers, money center banks at a elevated price to book, let's say, over what they would have paid 5 years ago when they were being regulated like utilities. So now, like, there's a little bit more slack in the reins. I don't know that anyone could directly point at any specific financial stock and be like, oh yeah, deregulation is good for 20 cents per share in earnings for this company next quarter. I don't think it's quite that formulaic. I just think it's the climate, like it's the atmosphere, but it's helpful. It's a tailwind because, look, you think about the growth of, just as one example, private credit, like market making is another example. These are areas where the largest banks were told by the government, we don't want you there anymore. We don't want you doing this. So now the banks have been reduced to doing originations and turning over the lending business to Blue Owl or somebody else. And it's not that that's necessarily negative per se, but it's definitely held back the potential earnings power for these banks in what would otherwise be a roaring bull market. You've got stocks at all-time highs. You've got more millionaire households than ever, multi-millionaire households, explosive growth in 401k balances. You've got the middle class leveling up in their spending, which helps credit card companies. Like, these stocks have done well, but I would argue in this environment they should be doing better. And some would say the next catalyst will be the first rate cut. Okay. Maybe, gotta wait till September. Maybe that's true. But these stocks are doing well without them. So I like what Joe said about Interactive Brokers. That's on my best stocks list. I think that's going way higher. Just looking at the way Schwab and Robinhood have been treated, I think that stock should get a bigger rally. And there are tons of those stories everywhere I look in the sector. So I think it's going to continue to work. I think you want to be in financials into end of the year.
You know, to your point, the CEO of Interactive saying he sees another 2 or 3 years on the rally, I believe. Kate, I want to come over to you. By the way, Citi hitting a 52-week high, talking about these big banks moving higher. Is she
allowed to comment on that?
I'm not, but I think I'm allowed to smile.
You are definitely allowed to smile.
Yeah.
And by the way, talking about deregulation, we had the Treasury Secretary also talking about deregulation, saying the capitalization requirements are unnecessary burdens on financial institutions, talking about he wants to see more growth in the finance sector. So just talk to me more broadly about financials. And we see some people talking about some of the trading houses like an Interactive and a Schwab. Then, of course, you have the big banks and the regionals. Is there a certain area that you see as the most attractive?
Look, I think there's a lot of very strong stories across the entire sector. We've highlighted a few of them across regional banks, across some of the money centers. I think the important point here is that it has been an unloved sector for a considerable period of time. It has not been any place anyone's been taking big concentrated risk. They may pick a name or two here and there, especially for the active managers. But in general, it hasn't, occupied the space of being a consensus overweight. I will suggest, looking at the sell-side strategists, looking at recommendations, it is a consensus overweight right now, for the reasons we're talking about. A stable economy, maybe not explosive, the likelihood of future rate cuts, the expectation that the curve is going to steepen, and that the deregulatory story is going to be this tailwind for earnings. So I think it's reasonably well owned. This is why I pointed out before that we need to watch the price reaction. I will tell you, I was at a conference about 10 days ago, and it was a small group discussing their highest conviction calls. About half of us pitched regional banks. So I think that's a little bit of a warning sign in the near term, even if there are structural reasons to consider this sector as more of an anchor to portfolios today than it's been in the last 5 years.
I think what the regulatory relief does is it unlocks capital for M&A and for capital allocation strategies. And I don't think you dismiss this report this morning that Goldman Sachs is looking to make a big acquisition. Goldman Sachs isn't, I don't think, looking to make that big acquisition in the prior 4 years. I think this is something that is going to be rather popular in the financial services industry, where we're going to begin to see tie-ups that previously were never thought of.
You're going to see M&A, but you're also going to see more loan growth. This is what Jamie Dimon has been complaining about since 2008. The restrictions on capital, when you loosen that up, you can lend out to small and medium-sized businesses, and that's really important for the economy as a whole. So not only are you going to see buybacks going higher, which we are, and we're seeing a lot of various different shareholder value creation, but I think loan growth is really at the heart of this whole thing, and that's important.
Well, the buybacks, yeah, that's going to happen. But higher loan growth in a slowing economy, you see the two things happening at the same time?
I don't really see the economy. It's slowing, but it's still strong. It's above trend. 2.5% is above trend. Trend is 1.5% for this economy. So deregulation, lower taxes, CapEx cycles going higher. That's not going to lead to a 1% economy, 1.5% economy. I think it's going to stay strong, and I think they are going to lend, and that is something that has been missing from the banks over the last several years.